Good morning and welcome to the Wednesday session of the 2020 Diggers and Dealers Mining Forum here in Kalgoorlie, Western Australia. My name is Toby Dennis. I'm a director with Canaccord Genuity in the corporate finance team, and it is with great pleasure that we have a fantastic lineup this morning of 4 of the best companies on the ASX. And so with no further ado, we'll hand over to Jim Bayer, Managing Director of Regis Resources, to get us going. Jim is a mining engineer with a broad range of experience encompassing 30 years across a number of commodities, including gold, copper, uranium, lead, zinc and iron ore. He has strong gold industry experience, having been the GM of the Boddington Gold Mine, one of Australia's largest gold mines, and the GM of the Pajingo Gold Mine. Jim was the CEO of WA-based iron ore producer Mount Gibson Iron Limited for 7 years prior to joining Regis in late 2018.
Thanks, Toby, and thanks everyone for joining us this morning. Special thanks to the Diggers and Dealers team for the opportunity to talk to everybody, and well done to Miles and Sharon and also to Suzanne. Done a great job pulling this together. I draw your attention first to the cautionary statement. An interesting read, and if you want to spend some time on it, it's available on our, we've released this report on the ASX this morning with a lot more information on it. I'm just trying to touch on the highlights this morning. So, Regis Resources, a company that I think is known for consistency and growth, certainly in the early phases, and we're looking to maintain that tradition and build on it. We have been a consistent performer. We are low cost. We are in a strong financial position, no debt. At the end of the financial year, FY20, we had 209 million in cash and equivalents and no debt. We're a consistent dividend payer. We're building on our transparency and our ESG reporting, and we certainly believe we have a very clear and compelling, internally driven value growth profile. Just for those that aren't aware, we have 3 mines or 3 process plants in Western Australia on the Duketon Greenstone Belt. Between them, they have about 10 million tonnes of processing capacity. At Duketon, we've got currently 1.6 million in reserves, 5 million in resources. On the East Coast, we have a project called McPhillamys, and I'll talk a bit more in detail on that shortly. That has 2.7 million ounces in resources and just over 2 million ounces in reserves. On the ESG and reporting front, certainly the company historically has done a lot of sound work, but we see with the increasing standards that we place on ourselves and the expectations in the marketplace that we are increasing our standard of reporting and transparency. We structure our reporting in alignment with the United Nations Sustainability Development Goals. Last year we published our first sustainability report, and we're soon to release the current year in the next 2 or 3 weeks. We don't pretend to be best practice. We don't pretend to be anything. We don't pretend to be best practice, but what we're working on is being transparent, clear, succinct, and brief. And you'll continue to see that message in our release over the next coming weeks. The second thing that I mentioned is we're low cost. And thanks to Canaccord for this analysis, but this is a plot of a significant number of our peers plotted against US dollars per ounce all-in sustaining. And you can see that we're certainly sitting down in the bottom quartile of that group, a position that we take great pride in, but more importantly, we make great effort to ensure that we stay in that location. It's not easy, it takes hard work, and we continue to build our efforts on that front. Just spending a little bit of time looking back at the company's performance over the past financial year, it's been another strong year. We recorded a record net profit after tax of approximately $200 million. Our EBITDA, $395 million. And off the back of that excellent financial performance, we declared a full year dividend of 16 cents per share. For a total payout of around about $81 million. Now this is a pretty significant focus for our business. We make sure that we understand part of our reason to be is to grow value, and part of our reason to be is to return value. And we like to think that Regis has a history and a future of being able to do that. Since 2013, we've paid nearly $500 million in dividends. So you'd certainly see we've got a record of growth, but also of returns. The year as well saw starting 4 open pits, plus we started our underground at Rosemont. And on the future growth potential, we progressed McPhillamys, we tripled our exploration ground, we increased our exploration budget, and we've been progressing the next cab off the rank on the underground front at Garden Well. And I'll talk a little bit more about that shortly. Looking forward, the guidance for this year, we see an increase. Last year we produced 351,000 ounces. Our guidance for this year is 355 to 380. All-in sustaining costs of $1,230 to $1,300 Aussie an ounce. Our growth capital is down on the previous year. Last year we spent 90 million, this year 50 to 60. Our exploration spend is increasing to 35 million. McPhillamys, we're proposing to spend $15 million on it, which is an increase on prior years and reflective, I think, of the confidence that we've got of this project starting to make getting some real traction. And as I said, we're looking to see growth in our production, and as noted in there, we are certainly highlighting the fact that we're expecting our growth to come in the second half. The Rosemont Underground is a key contributor to our growth because of its high grade, and because of the mine plan and our approach there, we'll be hitting the high grade section underneath the main pit in the second half of the year. So we'll certainly see that lift coming early in the new calendar year. So what I wanted to touch on was our internal growth, value growth opportunities that we are pursuing. And basically we see there's 3 key planks for that. The first is a step change in value at McPhillamys. The second is an incremental increase in our production at Duketon, up to circa 400,000 ounces is our first objective. And the third and final plank of our growth, or our value growth strategy, is to increase and improve our life. The first, McPhillamys, a 2 million ounce deposit, reserves, 10-year plus, 10 or 11-year mine life at least. It will produce 150 to 200,000 ounces per annum, and we're predicting at the moment that the all-in sustaining costs will be somewhere between 1,100 and 1,200, although we're still working on that, and a lot of that is still open while we finalise the conditions of our approval. Middle of last year, we put in our formal development application along with a 7,500 page environmental impact study. That was assessed, it went public. We had it open for public questions. We got, I think it was around about 670 questions in October, November, and we've spent the better part of certainly the first part of this year answering every one of those questions in a report, and it's called the RTS, the Reply to Submissions. Very important part of the process. We submitted that about 8 weeks ago, and at the moment in New South Wales, this is assessed through the Department of Planning, and that's in that phase. In fact, I think the Department of Planning had a meeting with stakeholders in Blaney earlier this week as part of that process. Now we see certainly a couple of years ago, I think people might have thought that New South Wales was a challenging district to get approvals in, and I would say certainly compared to WA that was the case. But I think there's no doubt that the sentiment has changed there. The Planning Minister has done a review of the Independent Planning Commission and tightened up its scope. It's still an important and very critical part of the independent decision-making process, but it's clear that the scope of what they work on has been appropriately clarified. And we've certainly seen in the last few months, last 2 or 3 months, some significant projects being approved. The Vickery's Coal Project was approved, and more recently Santos's Narrabri coal seam gas or seam gas project has been approved as well. So we think there's a recognition, and while COVID has made things a little bit more difficult for us in terms of progressing the works that we want to do there, it's added to the understanding just what value resources brings to general industry and the economy, and the potential value that we can bring by building this project in New South Wales. The timing, we believe the Department of Planning will has indicated that we should get a response back from them by the end of the year. And while you can never be certain about these things, they may come back with more questions and we'll deal with those as they come. But certainly we're hoping that we'll get a recommendation from the Department of Planning, and from there it would be referred to the IPC for their final decision. The Minister has given broadly the IPC group 12 weeks to make that assessment. Now they can seek extensions if they see fit, granted in discussion, I think, with the Department of Planning. So it's quite conceivable that we could see McPhillamys approved certainly sometime in the June quarter next year. If that was the case, we would start construction early financial, or by this time next year we'd be in construction. And on that basis, we could see early production and commissioning at the back end of calendar 22. So we see that McPhillamys for us is now becoming very real. We've appointed a project manager and we're starting to build our team in Perth and get ready for the next phase of this very exciting and certainly significant value-driving project. The second part of our growth program is looking at what we do with Duketon. What can we do in the short term and in the near term with our existing assets? And the clear driver that helps us to increase our throughput there, given that we're mill constrained, is to increase the feed of grade. And we do that by adding in the underground. Rosemont, top right-hand corner, is the first project that we initiated. We started mining there early last year. We declared commercial production in June of this year, and that's what we've been doing. But as I mentioned earlier, the key for Duketon, Rosemont, really starts to kick in early next calendar year when we get to, and I know people who are watching this online or in the other room won't see it, but over here underneath the main pit is where the juicy grades are, and that's where we're heading. Now, we didn't head there to start with because we were still mining in the pit, and obviously you don't want to be mining over the top of your underground, but we expect to be there early in the new year, and that's when we can see that we will get certainly a second half kick in our production. But Rosemont, the existing approval at Rosemont Underground is not our only project, not our only scope. We see right from the start there was a view that Rosemont was going to be able to continue on at depth, and we have been drilling underneath it, and we're seeing all the indicators that Rosemont will be got the potential to be similar to a lot of underground gold plays here in Western Australia, where it's got 2 or 3 years of mine life, but has done so for the last 7 or 8 years. And certainly the drilling we've done underneath the existing design bottom of the mine is indicating that that's got that potential. So we see Rosemont going well. It's really going to start to make an impact on our production in the back end of this year. But we've got more underground potential. At the moment, we've finished the drilling of Garden Well, which is the bottom right-hand diagram. Garden Well South, it's starting to shape up. We've finished the drilling. Our designers and our engineers and geologists are looking at the underground potential there. And we're looking to make a decision on that late this year, by the end of December. Assuming a positive tick of approval there from the board, we can see development starting there early in the new year. It certainly wouldn't be expected to contribute to production this financial year, but I would anticipate on that timeline that it's got the potential to impact on FY22. But Garden Well's not the only option that we've got to add to our underground production sources. Garden Well North is an area that we haven't closely looked at, but we've started drilling there. That's got potential. We've certainly done a lot of drilling at Bannigo in the top left-hand corner of that chart, and that's about to be bundled up, and our geos and engineers having a closer look at modelling that as well. And certainly earlier in the knowledge stage, but Gloucester, which is in the far northwest of our holdings, has got underground potential as well. So we're looking and we're seeing. We've just got to do the work to continue to build on what we see is going to be a successful Rosemont has got potential to exist elsewhere. And just while I'm on this slide, I'll show the importance. I know I've had some comments from people that they take a view that Duketon is going to be solely an underground operation. Regis is moving to being solely underground, and it isn't. Understand that it's the underground that helps give us the sweetener. It's allowing us to ramp our production up. It's what we're using to get to 400,000 ounces and to hold that. If we didn't have the underground higher grade source, we would see a slight decline starting to occur in our production profile because the ore's getting deeper in our pits, it's getting a little bit harder, the throughputs drop, and the grades they're not dropping a lot, but it's subtle. The underground allows us to hold that and actually allows us to start to increase and bring us up to 400,000 and potentially more. So the last piece that we've got of adding value is looking at extending our life. McPhillamys gives us the step change in production. Duketon currently is on its path to 400,000. McPhillamys has got the potential to add 10 years of life at 150 to 200,000 ounces. The last piece of adding value to or growing the value of our company is to add life to Duketon. And we're doing that by focusing on three areas: acquiring ounces, optimising ounces, and finding ounces. The acquisitions that we've done just in the last few months, we purchased Ben Hur. It's a 300,000 ounce resource. We think it's got great potential. It's a perfect fit. It's only about 30 k's or so away from the Garden Well mill. It just fits exactly what we're looking for in our portfolio. It doesn't give us huge mine life, but it adds incremental time to us, which is exactly what we're looking for while we're chasing the main game of finding the next Garden Well or the next Rosemont. Ben Hur is open at depth, and it's clearly the drilling. There's plenty of opportunity we see along strike where, as our geos have gone through it, we see great opportunity for infill. So we're very excited about Ben Hur, and it just fits that piece of our strategy where we're looking to just acquire where it makes sense. We don't want to overpay, and add to our ounces and our production life. And on the ground that we picked up associated with Ben Hur, we also see some significant opportunity for greenfields exploration. The second part of extending our life sits around optimisation. This photo and the plan shows our Mullart well operations where we mined out. The pits were designed at a $1,600 an ounce, and that's where the holes are already been taken. The black outline is what the pits would look like if we used a $2,500 Aussie an ounce profile. Now, of course, that's pretty high. But what we find is that, and obviously as you go from a cut-off using 1,600 to 2,500, your average cost of those ounces is going to be significantly, probably somewhere in the middle. But we've found that what we've got is there's potentially 4 or 5 years of mill feed. So in the absence of any other feed towards the back end, this has got real potential. Now, are they as significant and high margin ounces as we're mining at the moment? Of course not. But I'd prefer to have low margin ounces than no ounces, and this is certainly an option that we can look at. Now, the key part of this work is to understand the risks. How many are expensive, how many ounces are sitting in that $2,500 or $2,300 to $2,400 an ounce all-in cost. How do we manage that risk? When do they come? Can we hedge it just to cover them, to ensure that we cover our costs and we float and our opportunity sits on the other, possibly, 75% or 2/3 of the lower cost ounces. And we're working on that. That's got great potential to add life. The final area is we find it. And if you do find it, that's where real value is created. Now, in the last 12 or 14 months, we've tripled the amount of ground. We used to hold 1,000 square kilometres. We now hold 3, control 3. Just over 93% of the ground across the Duketon belt. We've substantially increased our greenfields exploration. Over the years, it was between $4 to $7 million a year. Last year, we've stepped that up, and this year we'll be spending $25 million on greenfields. Now, we've picked up a lot of ground with a lot of potential targets. It hasn't been, explored with the understanding and the IP that we have developed in-house and the understanding of the ore deposition models because that's what we hold, and we're now applying that to this new ground that we picked up. And we've identified 5 key areas at this early stage, and we're already starting to get some pretty exciting early sniffs. And that's at Beetlejuice. Beetlejuice is sitting in the, on the western side, the northwestern area of the belt. And we went in, we did early stage lag sampling, and that identified some geochemical anomalies. We've undertaken some air core drilling on large spacing, 800 metres or so. And then on this early work, we've already found 5 kilometres of strike of an anomaly that's above 0.5 gram a tonne. Now granted, it is early days. We've put a diamond drill hole in to make sure that it's got the geology that sits deeper as the indications of a decent formation, and it does. And so we've really started to ramp up our RC and other exploration work. Now, if this comes off, it would be fantastic, the first thing that we walk up to. Statistics tells us that that would be nice and lucky, and give me a lucky geo any day. But we'll pursue this, and we've also got other opportunities that are probably as exciting as this one, but not quite as advanced, all through the belt. So we think we've got some great opportunity to extend our life, and this is what adds value by going beyond that 4 or 5 years that we currently have in mine life with our existing reserves. So, 3 parts. Whoops, pardon me. 3 parts to our growth, value growth. Increasing Duketon up to 400,000 off the back of our underground. The step change in McPhillamys will be material. It will change the life profile of Regis. And longer life through sensible acquisition, longer life at Duketon through sensible acquisition, real exploration and mine optimisation. So in summary, and look, one thing while I do, I have spoken only about our internal. There's no doubt we continue to look at M&A, external opportunities as well. I would say that the current price is certainly putting a significant price or premium. And if there's one thing that we have in place with our growth and our strategy for growing the company, it's ensuring that we manage the risk. These are fine times, there's absolutely no doubt about it, but we look to be in for the long game, and we need to make sure that any investment that we undertake is not a short-term game and leaving behind a legacy of risk in the company for our shareholders. So we're cautious, we're looking, but as I said, we are cautious. So in summary, we're consistent in our operational delivery. Historically, we're certainly going through a change phase now as we ramp ourselves up to 400,000. We are amongst the lowest cost producers. We have a strong record of not only growing but delivering dividend returns. And I hope that you've seen and understood that we have a very clear and strong internal value growth strategy. Thank you.
Thank you, Jim. We actually have a moment for 1 or 2 questions. If there aren't any, I actually have one, Jim. So your FY21 budget has 35 million in there for exploration, and 25 of which is for greenfields. Can you elaborate on where that will be going at this stage?
Yeah, across the ground that we picked up. There's certainly a fair chunk of it will go into pursuing Beetlejuice to see how that goes. But we've got to be very careful. You know, exploration, we've got a lot of options. We need to make sure that we, you know, if the data that we get doesn't support what we're after, then we need to be, quite frankly, ruthless and move on. But we can do, because we've got lots of opportunities. So that money that we've spent, that 24 million, will be across that greenfields, a little bit of brownfields work, but mostly across the greenfields area.
Great, thanks once again, Jim.
Thank you.